The global financial system is quietly approaching a turning point, and institutional investors are already making their moves. While headlines continue to focus on inflation, central bank speeches, and short-term market volatility, the real story is happening beneath the surface. The next interest rate shift, whether it's a pause, a cut, or even an unexpected hike, is not just a policy change, it's a signal. And for institutions managing billions, sometimes trillions of dollars, positioning ahead of that signal is everything. Right now, the biggest players in the market, hedge funds, pension funds, sovereign wealth funds, and asset managers, are not waiting for confirmation. They are preparing in advance. Historically, by the time central banks officially change direction, institutional money has already moved. This is because these investors don't react to news. They anticipate it. They study economic data trends, liquidity conditions, bond market behavior, and subtle shifts in credit markets to position themselves early. One of the clearest signs of this positioning can be seen in the bond market. Over the past few months, there has been a noticeable shift in demand for longer duration government bonds. This typically signals that institutions expect interest rates to fall in the future. When rates drop, existing bonds with higher yields become more valuable. So by locking in these yields now, institutions are effectively placing a bet on the direction of monetary policy. At the same time, there's been a quiet rotation happening within equities. Instead of chasing high-growth, high-risk tech stocks like we saw during periods of low interest rates, institutional investors are increasingly favoring defensive sectors. These include healthcare, utilities, and consumer staples, industries that tend to perform well even when economic growth slows. This shift suggests that big money is preparing not just for a rate change, but for a broader economic transition. Another critical area to watch is cash positioning. It might sound surprising, but many large funds have been increasing their cash allocations. This isn't a sign of fear, it's a strategy. Holding cash gives institutions flexibility. When the rate shift finally happens and markets react, they'll have the liquidity ready to deploy into undervalued assets. In other words, they're preparing to buy when others panic. Private markets are also playing a major role in this transition. Institutional investors are allocating more capital to private equity, infrastructure, and real assets. These investments are less sensitive to short-term rate fluctuations and often provide stable, long-term returns. Another important trend is the renewed focus on credit markets. Institutions are becoming more selective about where they lend money. High-yield bonds, which carry more risk, are being approached with caution. Meanwhile, investment-grade credit is gaining attention. Currency markets are also giving clues. Large institutions are adjusting their exposure to the US dollar and other major currencies based on expected rate differentials. If the Federal Reserve begins to cut rates before other central banks, the dollar could weaken. What's particularly interesting is that this positioning is not based on certainty, it's based on probabilities. Institutional investors don't need to be 100% right. They structure their portfolios in a way that performs well across multiple scenarios through diversification, hedging strategies, and dynamic asset allocation. Retail investors often react too late, but those who understand institutional behavior gain an edge. As we move closer to the next phase of the economic cycle, one thing is clear: institutional investors are not guessing, they are positioning, and those who understand this shift early will be far better prepared for what comes next.